So far, it seems like the stock market is completely ignoring the fact that these rate hikes are going to go higher and they're going to remain high for much longer than previously expected. But when we get to the technical analysis portion of this video, you're going to see why the market might change course this week. Hi guys, it's Stock Curry, and last week was a crazy week in the markets with some insane volatility. I'm going to briefly recap what happened, then we're going to talk about what's coming up this week with all of the news, and we're going to go over some technical analysis. So let's get into it. Here's what happened last week. On Wednesday, the market rose over 4% after Jerome Powell gave some remarks. Now, I'm going to go over a little bit more about what he said and how the market reacted in a minute. But first, I want to talk about the economic reports that came out on Thursday and Friday, which showed a very difficult situation for the U.S. economy. On Thursday, the PCE, or Personal Consumption Expenditures Price Index, rose 0.2% month over month. Now, this initially seemed like a good thing and shows that inflation might be slowing down. But on Friday, the payroll numbers came out and they show that wages were well above expectations. In fact, the average hourly earnings jumped 0.6% for the month. Now, you have to keep in mind that the Federal Reserve uses the PCE numbers that came out on Thursday in order to determine how much to raise interest rates by. And the fact that they rose 0.2% was really, really good because it points to the Fed might being able to slow down the rate of rate increases. And that is helping cause the economy and especially the stock market to rise. Now, the one problem, though, is that on Friday, when we got the wage numbers and they showed that hourly wages rose by 0.6%, well, this is a big problem because if wages are going up by 0.6% month over month and inflation is going up by 0.2% month over month, that means wages are growing up faster than inflation is going up. And that is how we get into something called a wage price spiral. A wage price spiral is when wages start going up because of higher inflation expectations, and those higher wages give people more spending power, which in turn causes inflation go up, and that inflation going up causes people to ask for more money and more raises, which in turn causes wages to go up. Those higher wages cause inflation to go up. That higher inflation causes wages to go up. Those higher wages cause inflation to go up. Higher inflation causes wages to go up. And it's this wage price spiral, and it spirals out of control until we end up in a period with hyperinflation. And the problem is, once a wage price spiral starts, the Fed is not able to stop it. Monetary policy is no longer effective. The Fed can raise interest rates all they want, and if food and energy and shelter costs keep going up, then wages have to keep going up, and the wage price spiral doesn't end. It just results in hyperinflation, which is really, really bad news going into 2023. And it means that if the Fed is going to get this under control, they have to get it under control now, which means they're going to have to do a higher rate increase, or at the very least, they're going to have to keep raising rates longer than had previously been anticipated. Let's go back to what Jerome Powell said on Wednesday, because the Fed's path to a Goldilocks economy, or a soft landing, is getting less and less likely. Jefferies' chief financial economist said the Fed cannot afford to take its foot off the gas at this point for fear that inflation expectations will rebound higher. Because wages are going up at such a fast pace, if the Fed slows down the rate of rate increases, this could cause inflation to come back. The Fed has to stay hawkish and has to continue raising rates if they're going to stop a wage price spiral from getting out of hand. A wage price spiral means more of the same for the Fed, continued interest rate hikes. Even if they're a bit smaller than the 0.75 percentage point per meeting run that the central bank had been on since June. Now, this is where we get to something very interesting that Jerome Powell said on Wednesday that the market so far have seemed to ignore. And that is the fact that Jerome Powell said that if wages came in higher than expected, that could be a big problem. In a speech at the Brookings Institution on Wednesday, Jerome Powell said he expected the Fed would cut the size of its rate hikes. Now, that's the part of the speech that the markets really seem to like, and that's what caused the stock market to rise 4% on Wednesday. Jerome Powell also said that the Fed would likely have to take rates up higher than previously thought and leave them there for an extended period of time. That was the part of the speech the market seemed to completely ignore. Chief U.S. economist at SMBC said the November employment report is precisely what Chair Powell told us earlier this week that he is most worried about. Wages are rising more than productivity. To restore labor demand and supply, monetary policy must become more restrictive and remain there for an extended period. So far, it seems like the stock market is completely ignoring the fact that these rate hikes are going to go higher and they're going to remain high for much longer than previously expected. But when we get to the technical analysis portion of this video, you're going to see why the market might change course this week. First, we got some more news coming out that shows inflation might start rising again. OPEC Plus has agreed to stick to its existing policy of reducing oil production. There were some hopes that as Russian oil got banned, that OPEC might change course and decide to keep producing at a higher rate. However, they said that they would stick to continuing to reduce their output production. OPEC and non-OPEC producers decided to stick to its existing policy of reducing oil production by 2 million barrels per day, or about 2% of the world demand. That would start in November and continue through the end of 2023. And as OPEC cuts the amount of oil that they're producing, we can expect oil prices to rise. But it's not just OPEC that's going to cause oil prices to rise. The U.S. is going to be playing a pretty heavy hand in this as well. The United States has been reducing its strategic oil reserves at a rate of 1 million barrels per day. However, those oil reserves are now at a critically low level, and the White House is now hoping to refill those oil reserves. The amount of crude oil in the Strategic Petroleum Reserve has declined by 204 million barrels so far this year, with current levels at just 389 million barrels, which is the lowest level since March of 1984. The Strategic Petroleum Reserve, it is at a critically low level, and the White House cannot afford to release any more oil from the SPR. What this means is that the demand for oil will remain high, yet the supply of oil is now going to go down. It's going to be released by 2 million barrels per day from OPEC, and it's going to be reduced by another 1 million barrels per day from the US SPR. Combined, that's 3 million barrels per day, about 3% of the world's total output production. And while you might think this might only raise oil prices by 3%, that unfortunately is not the way that it works. Oil prices will rise significantly higher than where they are today. Here's what's happening this week and in the weeks ahead. Let's take a look at the economic reports that are coming out this week. While there are some minor reports coming out throughout the week, the major reports come out on Friday. On Friday, the Labor Department releases its November Producer Price Index, or PPI, which is showing the inflation that suppliers charge businesses and other customers. PPI can give us an early indication to where consumer prices might be in the months ahead, affecting both CPI and the PCE. Also on Friday, the University of Michigan will release its preliminary consumer sentiment index. This will be important because the Federal Reserve uses consumer sentiment and consumer expectations for inflation in order to determine where inflation might be in the future and to help drive their decisions on how much to raise interest rates by. Moving on to earnings this week, there are no major earnings coming out this week, but there might be a few stocks you guys might be invested in. Monday before the open, we've got Veru, and then Monday after the close, we've got GitLab. Tuesday before the open, we've got AutoZone, and then Tuesday after the close, we've got MongoDB, Dave & Buster's, Smith & Wesson, and Toll Brothers. Then Wednesday before the open, we've got Academy Sports. Then Wednesday after the close is GameStop. Of course, the GameStop apes say that buying GameStop is all about a short squeeze and has nothing to do with the value of the stock, so earnings should not technically affect the stock. Thursday before the open, we've got Express. Then Thursday after the close, we've got Costco, Lululemon, and DocuSign, as well as Chewy. And then Friday before the open, we've got Li Auto. Here's my technical analysis on the stock market. Earlier, I talked about how the markets were ignoring the bad parts of Jerome Powell's speech and only focusing on the good parts. But it looks like there's a possibility for that all to change this week and for the markets to start going back down. First, taking a look at SPY, which is an S&P 500 ETF, you can see a downward trend line here where we have these 3 touch points on the downward trend line. There's actually a 4th one covered up where the market had topped out. Now, based upon these 3 touch points, this was one technical indicator that the market might be ready to rebound and start going back down again. I also want to show you the VIX, which is a volatility index. Whenever the VIX goes down, the market goes up. And whenever the VIX goes up, the market goes down. Now, over the past few weeks, the market has been going up. And as you can see, the VIX has been going down. However, the VIX closed on Friday at 19. And every single time this year, when the VIX has gotten down to between 18 and 20, the VIX has bottomed out, turned around, and started going back up. And so the VIX is now in that range where it will start going back up. At least it has every single time this year. So if the VIX does rebound here, just like it has every single time this year, then the market will have topped out and the market is going to start going back down. So all of these indicate that the market is topped out and it's going to start going back down. Now, there is also the possibility that the market does not stop here and it actually continues to go higher. If the market does continue to go higher this week and we see the VIX fall below 18, then that means a rebound is not going to happen like it has all year long. And instead, we're on track to have a really big rally in December. Now, I don't expect that rally to last because the reality of the economy is eventually going to cause people to wake up and start selling off the stocks again. But at least for now, there is a chance that we have a big rally in December if these technicals break and we don't rebound off the VIX, and if we don't turn around off the SPY and this downward trend line we've been on all year. And because we are literally at this point right now where we could go either way, you're probably going to have a lot of people, maybe half the people saying, oh, we're going to continue higher. And you probably have another half the people saying, we topped out, we're going to go ahead and go down. Because we honestly just don't know. We do know that we are at the point where a decision has to be made. And this week is going to determine whether we go on a massive rally in December or if we sell off in December. This is the week that will determine that. So we're all really going to have to look at what happens this week to know what will happen for the rest of December. Now let's talk about one stock in particular that has been running up massively over the past few days that I know a lot of you guys are invested in, and we'll talk about whether you might want to hold it or sell it. Gold mining stocks have been running up like crazy over the past 2 weeks, and nobody's really sure why. Gold itself has not been rising that much, but gold stocks have been. And one of the stocks that is a gold miner that a lot of people are invested in is GLDG, or GoldMining Inc. And this stock, I believe, has run up too much too fast. And I think that there's a good chance that the top is near in the short term. So if you did buy this around 80 to a dollar, 80 cents to a dollar, you might want to consider taking profits here. As you can see circled is the RSI, and anytime the RSI is above 70, that means the stock is overbought. The RSI on the daily chart is currently at 87, which is extremely overbought, and there's a good chance that GLDG might be nearing the top of this run in the short term. So it's a good chance we're going to have a bit of a pullback. I don't know how far that pullback will be, maybe down to $1.30, $1.20, $1.10, who knows, but there's a good chance that GLDG is going to pull back before the next leg upward. Now, during this time of great uncertainty, it can be very difficult to make money on the stock market as a trader, because if you don't know which direction stocks are going to go, it's very hard to know how to make money. However, there are some option strategies that will make money whether stocks go up, down, or flat. And that is exactly what I did with a Tesla credit call spread this week. Earlier this week, I sold a Tesla credit call spread. Now, this call spread will make money if the stock goes up a little bit, trades flat, or goes down a little bit, or goes down a lot. This option had a 90% chance of making money. And as you can see here, we ended up closing this on Friday for 90% profit. If you want to learn how you can do these more complicated multi-leg option spreads where you can make money no matter what a stock does, then come join me in my coaching program where I will teach you how to make money no matter whether the stock goes up, down, or flat. And I will teach you all of these complicated multi-leg option strategies so that you'll know how to execute them so that you can make more money in your portfolio. Schedule a call with an onboarding specialist who can explain the whole program to you and determine whether or not this might be a good fit for you or not. You can schedule a call with an onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going on this week in the stock market as well. And don't forget to hit the like button and subscribe. And if you want to know more about what's going on in the market, you can watch the last video that I uploaded here.